Kia ora and welcome. My name is Dalvon Sala and I'm the Business Development Manager here at Tommy's Property Management, and you are tuning in to Property Tax and everything you need to know. I'm joined here by Brendon Trass of Pocock Tong Trass. Now Brendon, for those who don't know you at home, could you please let them know about yourself?
Thanks, Dally. Kia ora, everybody. As Dalvon mentioned, my name is Brendon Trass. I'm a Director at Pocock Tong Trass Chartered Accountants, and we're a bespoke accountancy practice located right here in the heart of Wellington. We've been in business for about 30 years now, just over. And we've got a pretty broad range of clients across most industries that you can think of, but more specifically in the property sector, I guess we kind of range from your large-scale developers to your residential construction builders, real estate agencies, property managers, and right down to your mum and dad landlords, whether they've got one property or multiple. So I'd like to think we've pretty much got our bases covered when it comes to the property tax landscape.
Well, I think so. Now, what are you going to be talking about this evening, Brendon?
So this evening we're going to talk through the recent tax changes that were announced back in March by the government, specifically around the Brightline Test and the interest deductibility removal. It's been just completely targeted at property investors. It's worth noting that a lot of these changes still haven't actually been enacted into legislation, so Don't get me started on that wavelength. It's
another kettle fish.
Exactly. But basically what I'm going to be saying today is based on the guidance that the government has given out so far and what's contained in their supplementary order papers. I'd also just like to put a quick disclaimer out there that everyone's tax situation and tax position is different, so whatever I say today shouldn't really be taken as tax advice, and you should actually seek clarification in your own circumstances if you need to.
Perfect. So Brendon, what brought about these changes?
Ultimately, the government has been trying to address our country's housing affordability problem for a while. So what they want to do is try and free up more owner-occupied properties and, I guess, create a more competitive housing market. And then what they're effectively aiming to do is disincentivise the short turnarounds between buying and selling properties, and that's effectively tainting all property investors as speculators, I guess, for want of a better word, and B, disincentivise people from, I guess, holding multiple properties and using what's called negative gearing to fund the purchase of those.
And now Brightline Test, what is that, for those who don't know?
Well, generally speaking, if you sell a rental property that you've owned for less than 10 years, then the gain that you make on that sale is going to be taxable. It's important, and that's if it's not your main home, obviously. It's important to note, though, that you can only have one main home. So this rule doesn't just catch your rental properties, it also catches your batches, your second home, the apartment you've got for your kids, all of that sort of stuff as well.
Awesome. And what has changed?
Well, back in 2015, the Brightline Test was first introduced by the national government, and that was essentially to remove the ambiguity that was in the previous intention test, for want of a better word. That was that previously you only paid tax if you bought a property with the intention of selling it. It was quite a common argument, though, that you never intended to sell the property, your circumstances just changed and you decided to sell. So as you can imagine, the word intention is quite vague, and it's quite difficult for the IRD to prove. I mean, that intention section of the law still applies. It always has. It was always in there before. It still is in there. Regardless of the length you hold your property for, if you bought it with the intention of selling, then there's no excuses. But the Brightline Test effectively, I guess, created that no excuses framework for short-term turnarounds and speculation. The test was then extended to 5 years by Labor in 2018, and then these new rules have extended it out to 10 years for any properties bought after March 2021. I guess one small concession in these new rules is that anything that meets the definition of a new build will still be under that 5-year rule. Thankfully, as of a couple of weeks ago, we finally got some clarification on what a new build will be. But I'll go into that in a bit more detail once we get onto the interest deductibility side, because it's quite a bit more relevant for that. But in simple terms, I guess a new build is something that's received code compliance certificate since on or after 27th of March this year.
Now, have main home exclusions narrowed down a bit? Or?
They have, yeah. Previously, under the old Brightline rules, if you owned a property for, say, 4.5 years and you lived in it for 3 of those years, rented it out for 1.5, then for the majority of the time you owned it, it was your main home, so you were completely excluded from the Brightline. These new rules have kind of brought in a new, I guess, period, a test. If you don't live in it for 12 consecutive months, then you now have to apportion that time period against the eventual sale. So using that example I just gave, if you owned a house for 4.5 years and rented it for 1.5 of those 4.5, that's about 33%. So 33% of your eventual gain then hits the tax net.
Okay, Brendon. Well, traps to watch out for.
Yeah.
Are there many?
Well, I've got on the slide there, the first one there is, I guess, well, the first two, when have you acquired and when have you sold a property? They can have different timings depending on the type of property transaction, and they differ between acquisition and sale. So generally speaking, for a standard land and building purchase, which is the land purchase, the term acquired will be when the title transfers into your name.
Okay.
However, you can actually be in the Brightline Test, that's when your period starts, you can actually be in there when you actually enter that sale and purchase agreement.
Perfect.
Not to be confused with buying off the plans like an apartment development or something like that, where you actually enter a contract now and it might be 2-3 years before that building's finished.
Yep.
In that example, your actual Brightline period starts back when you entered that contract. So those two are quite different. When you're selling a property, however, generally when you enter that sale and purchase agreement, that's what can trigger your Brightline obligation. So you may delay settlement till outside that 5 years or 10 years or whatever rule you're in. But if you entered that contract before that Brightline period's up, then you're getting in a bit of a tricky situation. That's where you've just got to be careful if you're kind of getting to the edge of that border of your Brightline period, just to really consider what that timing is. Yeah.
Absolutely. And ditto, of course, but when have you sold a property, really?
Well, that's what I just covered.
Of course. Might have to cut that one out. Although...
And when did these changes take effect?
When did these changes? So, when did these changes take effect?
Well, so they actually took effect. I mean, there's been a lot of focus, I guess, on that 27th of March date, and that's when the government said that they all kick in. But the government actually made that announcement on the 23rd of March. And so you may think, what's 4 days? But the ruling that they've effectively put out is if you had a sale and purchase agreement in place that you could have revoked before the 27th, and you didn't, then you're into the new rules. You chose to carry on with that investment. So that basically says if you had a conditional offer that you could have got out of. If you had an unconditional offer in place on the 23rd, however, you're in those old rules. So that 23rd, 27th, both of them have sort of tricky rules associated with them. So it's, again, just another thing to be aware of.
So was there ever a grace period or anything like that for that?
They just stood up on stage and told everyone about it.
Well, changes are changes.
It is.
And of course, what do these changes mean for you?
I mean, structure is very important from day one. It always has been, but especially now when you consider that also the top tax rate changed at the same time as these announcements happened. For anyone over 180 grand in their personal capacity is now 39%. I mean, 10 years of owning a rental property is a long time to, I guess, plan for anything that might change, and your life circumstances may lead you to make different decisions. You might have kids, you might get made redundant, you all of a sudden need to free up some cash by selling an asset like a house. But as I mentioned earlier, the Brightline Test took away any excuses in that period. So now you've got 10 years where you've got no excuse and you've effectively got a capital gains tax. So if you're kind of a top-ish earner and all of a sudden now you've got a 39% gain when previously you thought you were just going to have capital gains, you're now losing almost 40% potentially. So it does
take a hindrance.
Yeah, I mean, I'm not saying everyone should rush out and set up trusts and look through companies and things like that to try and minimise any tax obligations, because, as I said right at the very start, that everyone's tax position is different. It might not work.
Completely.
But the question is that you should ask yourself on day one is do I have my ownership structure right, and is it going to work for my life circumstances?
Brendon, now what were the rules and what are the new rules coming into play?
Yeah, well, I mean, before these new rules were announced, quite simply, residential investors could claim interest deductions against their rental income when they were calculating their tax. This deductibility concept applied almost universally across the Income Tax Act, and it meant that our tax system was quite fair and consistent and didn't really encourage the investment in one asset class over another. The proposed new rules, however, interest will be fully not deductible from 1 October a month ago, 2021, and that's for new residential properties that have been acquired since the 27th of March 2021. For any properties that were already held prior to the 27th of March, then there's going to be a phased approach removing that deductibility. So it'll be 75% from 1 October 21 for 18 months, 50% from 1 April 23 for a year, 25% from 1 April 24 for a year, and then no deductibility at all from 1 April 25. Any new borrowing is going to be instantly not deductible from the 1st of October 21, which is it's a huge disincentive if you've got a property facing a major repair job or healthy homes improvements that you have to do, and now you don't have that cash available. You've got to go borrow for it, but you've got no tax incentive for the borrowing. So bit of a tough one there, but
span in the works.
It is, yes. I mean, these rules are specifically hitting properties that meet the definition of what's been termed a disallowed residential property, which is basically any land in New Zealand that either has a place configured as a residence on it, or the owner has an arrangement to build a residence on it, or bare land that could be used to build a residence on it under the district plan. So in general terms, it's anything that an owner-occupier property, that could be an owner-occupier property, but currently isn't, so that catches your Airbnbs and those sorts of things as well. One major proposal, though, that the government has included in the latest release was that the deduction of interest could be back claimed against an eventual sale if the sale proceeds become taxable. So what that means is that, if you end up with a Brightline income or income under any of the other land tax provisions, then you'd be entitled to claim all of that interest paid back against that income. Effectively, you're adjusting the cost base of that property back on day one.
You mentioned some exclusions, of course. What are they?
Well, there's a few listed there, and I'll go into a bit of detail. Yeah. The main one that the government has come up with, and it's quite crucial, is new builds. We touched on it briefly back when we were talking about the Brightline Test, but ultimately anything that's had its Code of Compliance certificate issued after 27th of March 2021 will be a new build. And that new build status will continue to apply to that property for 20 years after that certificate's issued. It's certainly a lot longer than anyone thought it was going to be when they first announced these changes. Everyone sort of started freaking out, saying it's going to discourage development and everything. So quite a positive step there, I think. There will be a special rule for properties that have been brought off plans, and that the exemption period begins when you first entered into the sale and purchase agreement for that property, not necessarily when the title's issued. And that new build status will also be passed on to any subsequent owners in that 20-year period. So if these rules are still in place in 15 years' time, it's going to be fun trying to look back and remember the date 27th of March 2021 and know whether this property is a 15-year-old new build or not.
I like that.
The new build category is going to include also any new dwellings added to land where there's already an existing dwelling. So and with the new changes to the resource consent process where you can start building properties on your back lawn, it's going to be crucial around that. However, you're going to have to apportion the interest costs amongst the property that's already there versus the new build. In simple terms, a new build is going to be something that adds to the existing residential housing supply. It's creating homes, which is what the government's trying to achieve. A couple of those other exclusions there. The main home I've mentioned. If you've got boarders or flatmates, then you can still apportion your interest on those rules. Student accommodation, employee accommodation, farmland, which includes any dwellings such as the farmhouse or worker accommodation, your care facilities, so that's your rest homes, hospitals, they're all exempt, Māori land and foreign land. You may have heard me actually mention earlier that the definition of that disallowed residential property was any land in New Zealand that has those categories. So if you hold residential property overseas, you'll still be entitled to a full interest deduction on that. Next one I've got there is kāinga ora and social housing. It doesn't just mean giving discounted rent to a struggling family. It needs to actually be rented to one of those agencies who provide social housing services to those who need it.
So not necessarily anyone that's got tenants from WINS?
No, I think it's got to go through those actual agencies.
Okay.
And finally, this is a pretty, I think, clear exclusion, but I'll mention it anyway, is anyone who's actually in the business of dealing, subdividing, developing land. They're going to carry on getting their full deduction of interest as part of that business activity.
Easy. Well, thank you so much, Brendon. How do I be tax smart?
Well, the first one, I guess, is start planning your tax cash flow now. If your property is cash flow positive and can sustain that extra tax that you're going to have, then consider that. If not, why not? How can you make it cash positive? I guess there's not many ways you can reduce the costs associated with a property in terms of renting. Really. It's really only a matter of, well, do you have to put the rent up or put non-property based cash aside to cover that extra tax hit? Ultimately, you're better off thinking about these things now rather than waiting until sort of a year or two down the track and you get that tax bill and you haven't got the cash to pay it. So,
well, that would freak up a few people.
Well, yeah, exactly. But that kind of leads on to the provisional tax, which is the next point I've got there. And if people have had kind of small profits on their properties in the past, they may not have had any provisional tax obligations. But as soon as they get into those rules, it makes you pay your tax in the year you're in. And where that's going to, again, it's planning for that cash flow, but where it's going to, I guess, surprise a couple of people potentially is with the creep in those percentages of deductibility over the next 4 years, it also means that your profit is going to creep up over those years, which means your provisional tax for the next year is going to be short for the next year after that. So it's kind of a domino effect in that regard that, again, people just need to know about it, think about it, and prepare for that cash flow shock.
Refinancing?
Refinancing.
Of course.
Ultimately, and it's always been an issue with people, more so now that you've got similar debts on similar assets, but in the past it's been an issue with people restructuring a debt, combining two loans into one of them is deductible, the other one's not.
Of course.
So now it's going to be more important on that respect as well, where you've either got a fully deductible debt on a new build or a partially deductible debt or a no deductible debt on a newer property. So it's just making sure that if you do, I guess, refinance, you replace like with like on a fully deductible loan. If you don't, it's going to cause a couple of headaches for your accountants when it comes tax time.
And restructuring?
Well, just going back on that refinancing, there is one allowance that the government has given, similar to the restructuring and refinancing I mentioned earlier. It's if you are genuinely refinancing by switching banks, for example, and you do replace loan with loan, then they're not going to treat that as a new borrowing under those new rules I mentioned before. So they're not going to punish you in that regard. Restructuring.
Yeah.
Can you restructure around these rules? It's the old Kiwi yes and no. It's at this stage, these rules are here to stay. The national government has said that they will repeal them if they get into power. So whether that happens or not remains to be seen. But there's not really any way to restructure your way out of these rules while they're here. There were already some, I guess, anti-avoidance provisions when the ring fence loss rules came into place a couple of years ago.
Yeah.
And that was around, if you owned your properties in a company, for example, and you borrow money for the shares in that company, just because you've done a share investment doesn't necessarily mean you get the deductibility on that interest, because that company is what's called land rich. So it's got more than half of its assets in rental property, residential property. So similar sort of rules are going to apply to this. You can't try and keep your interest in a different vehicle to fund rental properties. It's going to kick in. But one major concession that I guess has been given, and this applies to both the Brightline and the interest deductibility, and I've touched on it before, if you do restructure your affairs for any kind of genuine reason, you will get what's called rollover relief. What that means is essentially your loans will not lose their deductible status just because they've moved into a new entity. Ditto, you won't reset the Brightline period by moving them. Previously, if you did it, you re-triggered the Brightline test. So as long as, I mentioned it briefly before, as long as that economic ownership of that entity kind of reflects the property that was there beforehand. So if you have spouse and spouse owning a property 50-50, and they sell it into a family trust where their trustees are beneficiaries and their kids are beneficiaries, or a look-through company where they're both shareholders of equal ownership as they had, then that would be deemed the same economic ownership structure. So, yeah.
What are your personal thoughts on all of this interest deductibility jargon, huh?
Well, how long
about 5 minutes, Brendon.
That's fine. I personally don't agree with the interest deductibility changes. I think I mentioned at the start that the whole notion about deductible expenses in our Tax Act was quite vital as an underlying concept of our tax system, and this goes completely against it. Even the Treasury and the IRD, they oppose these policy changes, and if you consider that the IRD is potentially going to get another $500 million a year of tax money, and they didn't want it, that kind of signals how controversial they are. The aim of these changes was to, I guess, make owner-occupied houses more available and more affordable.
Of course.
Whether it achieves that, time will tell. Exactly. But in the short term, I think personally it's going to have the reverse effect for a while. landlords are currently enjoying pretty high demand for tenancies.
Especially here in Wellington.
That's right, rents are high. And as I mentioned, you can't really plan your cash flow in terms of overhead management or control, because your rates are your rates, your insurance is your insurance. Body Corp is what it is. So the only way you can find extra cash is to, I guess, bump up the rent. Otherwise, potentially sell the property. Maybe that's what the government's wanting. That's the only other way around it.
So that's it from me. Well, mostly Brendon. And thank you guys all for tuning in this afternoon or this evening, depending on when you guys are watching this. If you guys ever have any questions or need any sort of accountancy help, you're more than welcome to reach out to Brendon at pttca.co.nz. Or you could reach me if you need any sort of rental help, Dally at tommysrentals.co.nz. Thank you.
Thanks for having me.